Yeah, good evening, everyone. Thanks for joining us today on a Saturday. Um, I am Sonam Srivastava and I have Siddharth here, Siddharth Garwal, who will talk about, we are going to talk about investor expectations and, what is the gap between people's understanding of the market and, what they're seeing. Uh, Siddharth, you excited about this?
Yes, 100%. I think it's the need of the hour, right? And there's so many expectations from investors in the market, and there's a gap. So I think this session would be really helpful.
Yeah. So in this session, we will take you through, what realistically the markets look like, what you should be expecting. Uh, so let me share my screen. All right. So the idea, like we said, is that we get people right now. A lot of people sort of have gotten into our portfolios in the last 6 months, right? And last 6 months have been very volatile. So people think that when you asked us to invest, we thought that you would give us very good returns every month. But what is happening is that the market is volatile. So obviously, any investment portfolio has been volatile. So we just wanted to do a revision of investor expectations, right? What people should be expecting from the market, and what is the nature of the market. So that is what we will try to do today. So the first thing is that if you look at various asset classes, you will see this is around 16 years CAGR, so 16-year return, compounded annual growth rate. So average return in these 16 years, you will see that Nifty gives you somewhere around 11-12% return on average over the last 16 years. Small cap index gives you some a bit higher, around 17% return. S&P 500 at the same time has had a lower return, right? Because it's a developed market which moves slowly. So it has given you around 7% return. Your government bonds have also given you 7% return, right? So obviously, investing in equity is very important, right? And why do I say it is very important is that if you look at this red line here, right? What that shows is that let's say you had put in 100 rupees in each of these asset classes. So your 100 rupees would have only grown to 200 rupees if you had put it in a very safe government bond, right? In these 15 years. But if the same amount of money you had put in, in the Nifty, you would have received more than 500. Your 100 rupees would have grown to 500, and same with small cap, which has grown to even 1000 rupees. So if you want to build long-term wealth, you have to invest into equities, and this is the nature of the market that that's why a lot of people are interested into investing into the markets, because in the long term, investing into equity gives you much better return than the highly safe options. But investing in the market is not a you know straight line, right? In market does not move. Market has gone up. We have the history from 1980s, right, which is around 42 years, and the market has gone up. It has grown from 1,000 to 60,000 in those 42 years. But that the journey is not straight line. There are times when there are drawdowns. There are a number of events that happen in the market, in the overall economy, the overall global ecosystem. So like initially we were marred by there were certain scams, or there were blasts, and there were things like that used to uh, affect the market. And then global financial crisis, and increasingly we are seeing more headwinds for the global market, and like the COVID-19 pandemic. So things like these keep on happening. Even right now, what we're seeing, where the US Fed is raising rates, or uh, the war in Ukraine is happening. These things affect the market, and this is part of the process. So
Uh,
while the market, yeah.
So Sonam, like when we were seeing this graph, I think as the audience would see it, right? The journey of Sensex, there's so many ups and downs,
Mm.
right? So as an
Yeah.
investor, what do you think can be done to, sort of manage this or counter this volatility of the ups and downs in the journey of investing?
See, I mean, see the so there are few types of investors, right? The people who really understand equity investing, or are high risk takers, they don't even diversify to other asset classes, right? They keep invested into
Right.
equity markets because they understand the nature that it is going to go up. But like some people or managers like us like to do risk management to even improve this chart, right? So if we deallocate it at the risky times, we move to safer assets at risky times, our return will even go higher.
Got
So
it.
things like
Makes
that,
sense.
deallocation, diversification, allocation to other asset classes are some things that you can do to improve on the chart even,
Right.
right? Right. So this is a part of like the risk is part of the process of equity investing, and like we all have seen the best performance when the market recovered from the COVID-19 crash, but the market actually went down only because of that crash. This is part of this process.
Yeah, I think in March when the first wave hit, the market actually crashed a lot.
Yeah, yeah. So I mean, the crashes and the recovery are part of the process, and recovery sometimes gives you the most accelerated returns, right? That when the
Right.
recovery is happening, you see that things are growing at a very rapid pace. But uh, you know, uh, market falls, recoveries, even stagnant markets are all part of the process, right? And long-term
Yes.
investors
Indeed.
should always look at the long term, right? Never at the short term. Uh, but yes, like I was saying that we have been, the reason for this stream is that we have been getting a lot of people have been complaining that I lost 4%, I lost 7%, I lost you know 8%. Like my loss is this much, right? And if you look at the index chart in the same period, you will see that the index has even fallen much more, right? So when the market has been in this direction and no sector apart from a few like FMCG has had a positive return during this time, right? In the last 6 months, it has been very very uh, volatile in the overall market, right? So this, you look at any type of equity investing strategies until and unless you have deallocated to another asset class, it is very tough to generate very high returns, right? Which is the nature of the market, right? So this is the reason for this team. If you want to talk to if you have invested here, right, which is at the top, or if you have invested here, which is again at the top, and you saw this as the first thing, then you would obviously feel disappointed. I know that if I had invested at the October top, which some of my clients who I work very actively with, they did, right? We got some clients to invest here, and then for the next 3-4 months, every month we would just explaining to them, you see the market is falling and we are doing slightly better than that. That is the best that you can do, and there is this is what we think the outlook would be, and that is the nature of investing. And whenever the recovery from this thing happens, you again see that your portfolios are recovering, or we will be doing stronger risk management to manage your losses if they are being made, right? So that is what I want to talk about. This is the nature of the market, that it doesn't move in a particular direction, and you will see crashes like this, right? But the problem is, like we saw this chart here, right? Let's say that you quit the market here, right? You quit at 2020. You said that I don't want to invest anymore. I have seen a 30% loss, whatever. I will not invest anymore. I am disappointed, right? Then you would have missed this almost, you know, like 2x rally, right? The market went 2x from here. So, so this is what we want to talk about. It these are very short term, right? A month, 2 months, 3 months is a very short span of time for you to look at the market. If you want to actually grow your wealth, you should be invested for the longer term, and you should understand that the volatility that we are seeing right now is because of some large unexpected risks, right?
Also, Sunam, I'll
So
launch the poll, right? So I'll let everybody, just put the poll answers together. Also, in the meantime, when I was seeing the graph that you showed just before this slide, right?
mm,
Um, there
mm,
were a lot of bottoms as you were showing, right? And there's this famous term in the
yeah,
market, buy the dip. So how does an investor actually time that, or can you talk something about that as well? About
yeah, yeah.
how to
So
time, buying that low because the recovery is after that.
no, definitely. So, I have received, I remember very distinctly that, in December, I received calls where you people were like, is this the time to buy the dip, right? Should I just put in everything because we expect the market to recover because, we had come from a very robust market, right? But, uh, but because of the global uncertainty, right? Like because of the uh, multiple things happening in the market, be it the US economy sort of crashing, to trouble in China, to whatever is happening in Ukraine, right? There hasn't been, one clear place where we could have seen that, okay, this is the bottom. Now things are going to go up, right? So ever since December,
Hmm.
I've been telling people that, we might be near the bottom, but it's very tough to say, right? Okay, it's done, right? So I mean, if you can invest
That's
here
true.
and again exit here, then that's perfect. But if you invested here and you kept invested, you would follow a particular path only, right?
Right. Right.
Yeah, and as long-term investors, so, this is part of the process, and we do things to ease this pain, but volatility is part of the process, like I said. So you launch the poll to that.
Yes, yes, the poll is live, and I think most of our viewers have already taken the poll, so probably we can end it and we can continue.
All right. So we asked
Yes,
people
perfect.
how much pissed they are, and I think we only received one or two, which means people are not pissed, right? So I think we can
Right.
be
I think
happy.
yeah, definitely. Right.
Definitely. So yeah, so me and Siddharth and Shweta and our team, we actually were talking last week, right? We were, that people are somewhat, complaining. What is the reason? Are we failing in terms of customer support? Are we not doing this right? Are we not doing
Right.
that right? But it sort of boils down that the market is not very favorable, and sometimes expectation mismatch can happen, right? And we have to
100%.
address that, right? Yeah,
Yes, very true.
great. Yeah. So next we want to talk about the types of risk in the market, right? So this is a chart of portfolio risk, right? Any portfolio, any stock has two types of risk. One part of the risk is systematic, and one part is called unsystematic. Systematic risk is something that is undiversifiable, right? Which is impacting the overall market. And unsystematic risk is which is very, very stock specific, right? So an example of unsystematic risk could be, let's say, what happened with the Adani stock sometimes back, or what happened with IRCTC. Like one particular company goes through something, right? Which could be because of some operational reason, because of some strategic reason, because of some competition coming in, the business model failing, or maybe some legal trouble, or some compliance or something or the other could impact one particular company, right? But you can diversify away that risk, that if I have a portfolio of 20 stocks, then one stock facing such type of a risk will not impact my overall portfolio, right? One stock falling even 10% does not impact my portfolio of 20 stocks. So you can diversify away that risk. This is part of the process. Again, like I mean, all risk is part of the process, but unsystematic risk can come anytime, right? That even in a bull market, one particular stock can have that unsystematic risk. But with a diversified basket, you will be able to recover from that risk because your overall portfolio is not impacted. But when we talk about systematic risk, Systematic risk is something that is undiversifiable. So what that means is that this thing impacts the overall market. It just impacts all stocks. This impacts stock market as a asset class, right? And you cannot, create any sort of diversification. All stocks are being impacted. And what are these risks? So inflation is one risk, interest rate hikes, unemployment, exchange rate, rising, any legal trouble for the overall country or some law changes, right? Some policy changes that could affect the market. Maybe let's say they raise the taxes, they raise uh, something or the other that can impact the market. Natural disaster like COVID-19 is a systematic risk where nothing would work when the market crashed during the first wave, or a political risk, right? That some political instability comes and overall the country becomes unstable. So things like these are undiversifiable, right? They impact the overall market, and there is little that you can do in your asset allocation. Obviously, you can better the solution. I mean, better the situation by being dynamic, but there is only little that you can do to mitigate these types of risks. So the risk that we are facing right now, right, in the market, it is not like, I think it is not a risk like whatever happened with the Adani stocks or whatever happened with the IRCTC or things like that. Right? Those were one-off events, right, with a particular stock. You see that you get over it, and the market continues in a particular direction. But the risk that we're seeing right now is a systematic risk. It impacts the overall market, right? And until and unless that situation becomes clearer, right, the overall market will be in a volatile state. So that is something for us to understand, that this is in this journey that we saw, right? So this is one of those scenarios where the market is not moving up, but it is sort of struggling, and eventually when the thing recovers, it will again jump back. Yeah, and like we said that crashes are, or any sort of corrections are not the end of the world, right? Every time the market has crashed in the history, like all the big crashes we have listed here, the crash in 2001, 2008, 11, 15, 20, every time the market has come back very, very strong in the 1 month, 3 months, 6 months horizon. And especially, country like India, which is a developing country, which has a lot of opportunities from all over the world, it will continue to see that growth part coming in. And if you compare the US market with the India market right now, you will see that the India market has been much more robust compared to the global
Also, Sunam, in this particular
market.
chart, right, I'm seeing that in 2008 the market crashed about 48%, and within 6 months
Mm.
it recouped back 48% and was
Yeah,
0.5% higher as well, right? So that is also quite interesting to see how the markets recover quickly within the span of few months after major crashes as well.
yeah. Yeah, I think, see, the markets are very much dependent on investor sentiment, right? Like people like you and me
Right.
invest, right? And we all
Correct.
panic
Correct.
sometimes. Uh,
True. That's human
and
nature,
and when
right?
the panic is over, people quickly want to, make back the money.
Right.
Uh, right? So, and also, talking about the current instance, like I said, the problem that we're seeing is that the US market is hiking rates, right?
Correct.
And uh, and that is not always a bad thing. Sometimes when the US market is hiking rate, it tends to be positive for the stock market. So we'll have to wait and watch. Like, a lot of economists are saying that the Indian economy is at a strong place. So we could see that the market, continue, stays robust even if whatever uncertainty might come in the future. So this is the chart that we posted last week, right, in the blog that Siddharth had written.
Correct.
Um,
We're talking about
yeah,
sectors, right?
yes. So this what this says is that the market follows, like economy follows a cycle and market follows another cycle, right? And these two cycles have a certain lag, right? Market might be moving a little bit ahead of the economy because they are much more active to react.
Right.
and in different scenarios of the cycle. Obviously, this is this chart is not at scale, right? So I mean, it's not like if your bull market lasted 2 months or 2 years, your bear market is going to last 2 years. These time periods have been shrinking increasingly, right? So what might happen
Right.
is that even if that the bear market is shorter than the bull market, which has been happening for a long time, right? Uh, but yeah, in different phases of the market, different sectors behave better, right? So in the market that we are all seeing that energy, FMCG, healthcare, things like these are working well, right? And as the market shifts, we will see that again, maybe towards the end of this quarter, at the end of next quarter, your other cyclical stocks and technology, things like that, again start getting steam.
Right. I think also the markets are, mostly based on
Mm.
future earnings and right future happenings. So it just factors in, I guess, whatever happens is going to happen right at this particular moment, and that's why there's this
Yeah,
sort of lag that we see, the overlapping as well.
yeah,
Yeah.
right, right. Uh, so the outlook is that, like we said, the risk that you're facing is systematic. It impacts everything, right? There's nothing that is not impacting, right? Be it from infrastructure to real estate to financials, IT, FMCG, autos, FMCG. Everybody is being impacted. Obviously, uh, FMCG and autos have had a lower impact, but every other sector has been impacted. All factors, right? Be it value, momentum, growth, quality, everything is impacted. Some a little more than the others, right? So we are in a systematic risk scenario. The problem is that growth is slowing down, inflation is rising. People are sort of skeptical what will happen. But the outlook is that the inflation that we are seeing could be because of transitory components like the war that's happening, and the COVID crisis that happened, and increasingly in the future we could see prices cooling off, and we sort of foresee that in a few months, again the infrastructure spending and the growth should start to happen as governments start pushing for that growth, right? Even governments are not very sure, what is going to happen right now, right? Central banks are also not very sure that should we start spending or not. That should we be conservative or should we be aggressive? So as things become clear in the next few months, we will see a clear path ahead. Now let's put out the second poll, right? So we want to
Sure.
know uh, that what are the people projecting, right? What is the performance that people
Correct.
see in the future? So guys, you will see a poll coming up on your screen where we are asking you that given the market scenario, how much returns do you see in the next year?
Right. I was reading a few questions though. Some individuals are asking, what about right researchers portfolios? What do you think would be their performance in the next 5 to 10 years?
No, definitely. So we are going to cover that in the next part of the session,
Sure.
right? We're getting a slightly low participation in the polls this time. Uh, so I think a lot of people are saying that they see 5%, 10% growth,
Right.
right?
Right.
And somebody even sees a 20% growth. I don't disagree. Even I see that. Next 6 months we would see a recovery. I mean, that's what I sort of believe. But we have to wait and see. I
Right.
mean, nobody can predict these things.
Yeah, and as investors, we have to be optimistic as well. That's the one notion that we should move forward with, in my opinion. Yeah.
Yeah, yeah. All right. So let's go over to the next slide, right? So here I want to cover, our couple of key portfolios, right? We have these two key portfolios, momentum and multi-factor. I want to talk about what happens to these portfolios in risk scenarios, right? So whenever the market is in a extreme risk scenario, you will see that the momentum portfolio here we are doing deallocation, right? I mean, see, right now the market that we have seen, it goes down by somewhere around 8-10%, then it recovers, it goes down 8-10%, then it recovers, right? So it is just a choppy, volatile market. It's not like a crash like 2020, 2008, right? So we have deallocated right now. We are deallocated around somewhere around 10-12%, right? And that's the nature of momentum investing. You can dampen the fall by deallocation, and when the market recovers, it momentum sort of recovers fastest. Momentum stocks are the ones that will pick up the fastest pace. So that is the nature of momentum in these extreme risk scenarios, right? So we will just repeat it that momentum does suffer drawdowns, right? Momentum will go down, when the market goes down. It's not like momentum is immune to any fall, right? Momentum does fall when the market falls. We can deallocate to reduce that fall, but whenever the market recovers, you will see that momentum really, really picks up, and then only you will see that the wide margin with which momentum has outperformed is because of the performance during the recovery period, right? So that is how momentum performs in these scenarios, and I'll talk about the expected returns from the momentum portfolio, right? So we, uh, we are Wright Research is a data-driven investor, quant investor, right? Neither me or Siddharth, select any stocks that go into this portfolio, right? What happens is that we run an algorithm that tells us that this is a basket where you have to invest, and this algorithm we have tested it over decades of data. We have seen all the scenarios, right? We've seen the scenario in 2017, 18, we have seen 2008, we have seen all the bull runs, all the crashes, and we have optimized this algorithm to make sure that even in this crisis scenario, it's not giving you a very bad performance. It is adding to outperformance. It is giving, we are managing the risk better, and we are allocating to the a diversified set of stocks that suit that particular scenario. So based on almost 10 years of data, our expected return is 35% on the momentum strategy. Obviously, again, 10 years is a short span of time for the market, right? Uh, uh, but still, we expect, even if the market is volatile, you can expect a good 25 to 30% long-term CAGR. So long-term means that at least think it for 2 to 3 years whenever you're investing in this portfolio. So this is what our expectation is, and we again repeat that it's a highly volatile, high volatility portfolio, right? So whenever the market will see instability, this will see instability, but when the market recovers or it is robust, momentum tends to perform. Creates this wide margin, right? So there's this distance between Nifty and momentum was this much, but during the recovery, it has just widened this gap, right? So this is what the nature of momentum investing is, right? So risk is part of the process, and momentum does see risk, but when there is recovery, momentum tends to be very, very robust. Our second portfolio that I wanted to talk about is the multi-factor portfolio. So this portfolio was actually live during that 2020 crash, right? We were 6-8 months old by that time. And, this is live data where we saw that when the market crashed somewhere 30%, our portfolios did not crash that much. Our portfolios only crashed 10-15% during the 2020 crash, right? Which was amazing for these portfolios. And that is because these portfolios also include gold, government bonds, liquid instruments, and they have an asset allocation there, and they are looking at other factors apart from momentum as well. So in risky scenarios, you will see that these portfolios are much more robust, and the current scenario that we are seeing is not this crash. It is just like crash like this that goes up, that goes down, goes up, that goes down, right? And the churn has been happening across sectors, right? So it is very difficult for a long-term investing strategy to continuously sort of beat or outperform until you have deallocated away all of it, right? Which is not ideal for a 10% crash, which is maybe does not make sense for a 10% crash. But in this scenario, our multi-factor tactical balance growth and conservative behave in this way. The expectation from these strategies is, you can expect a 25% CAGR from our growth, similar from balance, and conservative is slightly low. But the risk is much lower for a conservative portfolio, and for growth it is slightly higher, and for balance it is in the middle, right? So this is what we project, and this is the basis on which we started Wright Research. Right? This is what we started with. We created this research methodology through which we saw that if we allocate to different factors, if we allocate to different trade classes, then in any type of market scenarios, we would be outperforming the market in the longer term, and we would be giving you a much better compounded growth rate compared to the index, right? So you can just see it here that your index has grown to somewhere around 200 levels, whereas this has grown to 600 levels. So this is the whole idea of doing it, right? That we have tested it very rigorously across all scenarios, tried to incorporate as many factors to extract benefit here, and we see that it outperforms for the long term. So we'll put out our third poll, which is,
Yes.
why do you think that data-driven investing can give you more realistic expectations, right? But like I told you that we are doing data-driven investing, right? And we think that it is much. I mean, I can give you an expectation, and I can tell you that this is what I expect because I have tested this data, right? And I've tested it not just for 3 years, but for decades before that. In all sorts of scenarios, we have tested it out, and we try to incorporate everything that goes into the market, and that's how we are forming this expectation, right? It's not, and this expectation does not say that the market will not fall. The market will fall, and we're not saying that there will be a time where this strategy will not give you negative returns for some time. We're saying that this will happen, right? Because you've tested it out. But even with that, in the long term, we expect certain percentages return. That is because of the data-driven methodology that we follow. So this is the poll that we wanted to do. I think a lot of you have answered it correctly, that it is because of all of the above. We do scenario analysis, we look at different risk scenarios, we backtest over tens of years of data. Now for the most interesting part, now for the important part, right? So we are right now trying to incentivize. We saw that there's a gap, right? What we don't want people to do is, based on any sort of marketing, right? You invest maybe at the top for 1 month, and then you don't see that it's working well, and you leave after a month, and you say that, okay, Wright Research is not giving, Wright Research is a shitty product, right? We don't want that, right? That just destroys the whole experience, right? What we want people to do is to invest with us in the long term. So if you invest now and you look at the next 6 months, we do see that the markets are going to recover, right, from here, right? That's why only for these long-term plans, right? So our 6-month plan is already highly discounted compared to our 1-month plan. Right? So our 1-month plan is 500 and 6 months is 2000. So you're already at 1,000 rupee discount. And then again, if you use the coupon code long term, you will get a 30% discount on this 2,000 rupees. So you will get this at how much? At 1,400, which is the cost of less than 3 months, right? So I
Yes.
think this is a great time. We want to incentivize you. We want to, really encourage you to invest for the long term, right? I think, I think it's I sort of agree that, we have talked about returns a lot, right, Siddharth? Um,
Yes,
I
yes,
think that has,
indeed.
yeah,
Right, and also with long term, I think there's this thing that comes into the picture that better than timing the market, it makes sense to spend more time in the market, right? uh, so I think that sort of connects with the long term aspect,
mm,
where if you spend more time in the market, the chances of you generating better returns sort of increments.
yes, yes, and not just us, but everybody, right? In the last couple of
That's
years,
right.
has been just talking about, oh, I gave 6 months में सबसे ज़्यादा return, I gave this much
Right.
return in this time. See, I have crossed 100%, right? So I mean that sometimes distorts the customer's mindset, like that the subscriber's mindset. They think that okay, that's going to continue all the time, and which is I think we are mature investors and we should get the expectation right, right? That you will get
Correct.
a good benefit, right? These are valuable products, right? But only for the long term, right? They sometimes work very
Yes.
well for a 6 month horizon even, but to get a full flavor, you should invest for the long term. So along with this, Siddharth, you want to talk about the survey that we have?
Yes, yes, correct. So guys, we've created a survey, and we urge you all to fill that survey. I've posted the link on the chat box, and once you guys fill the
Mm.
whole survey, there's this surprise that we have for you, um, which is a bigger discount. So you should definitely make the most of it.
Yeah, and we are hosting this survey to sort of get to know you better, to understand your expectations better, and so that we can do more focused things for you. So that is the idea. We are not trying to collect any goodwill for ourselves. We will not post the results anywhere, right? So that it's not
Yeah,
like
I think
we
this
will
is more
start
of a
posting.
survey where we just want to hear our investors, um, and
Yeah, we want to
understand them even
understand.
better.
Yeah, we don't want anybody to have a bad experience, and we just want to understand, what people are expecting. Is there a mismatch? What can we do to sort of address it, right?
Correct.
Yeah, correct. Also, maybe we can talk about that there's a new community out there.
Oh yes, we should
So,
definitely. I've been sharing the link of our community during the conversation that we're having on the chat box, right? So guys, we have this new community that you should definitely join, and you'll get a lot of insights because it's peer-to-peer communication, uh,
hmm,
right? And you guys can post your questions there as well.
yeah. So let me share this with you. I will add the link to this community uh, on the website also, right? Soon.
Yes, I think that's a good idea. It'll
But
help people
before we
navigate.
share, yeah, yeah. So the idea is that with this community that we have created, right? Here we want people to discuss actively, people to put in their questions. It is sometimes we have our support channel, emails, chats everywhere, right? Any given time you would see 10, 20 people are asking the same question, right? And we will explain it to everybody, but it might be very helpful if there is one post where we put on an answer, and everybody can put in whatever doubts they have or whatever comments they have if they have better ideas, right? And it creates a knowledge base for everyone, right? So community.rightresearch.in, we will create more boards here we can put in, and we'll curate it. Me and Siddharth will moderate it. We'll try to answer as many questions as we can, and we want to create a
100%.
very good knowledge base out here, right?
Correct. Correct. I think that's the agenda of putting this community together.
All right. So that is
We
it from
have
the
a bunch
presentation.
of questions. Yeah,
Yeah. All right. So let's go to the question.
perfect. So I think we go to the first question. It's from Naresh. He's asking, does Wright in New India small case also follow regime modeling and sector rotation? He's asking about the methodology.
Yes. So in New India, see, the idea is that we want to invest into stocks that are gaining from PLI, China Plus One, and the other government schemes to do a infrastructure push, right? So the universe of stock is some 200 stocks, right, that we have identified. Right now, from these 200 stocks, how do you create a 20 stock basket, right? So what we do is we do regime modeling. When the market is uh, risky, then even in that basket, we are going to allocate to stocks that have slightly lower risk. And when the markets are strong, you will see that allocation will shift to slightly higher value stocks and higher momentum stocks. So we do incorporate some allocation techniques even within that basket. And same goes for the innovation basket, right? That the universe is based on that particular theme, but the methodology of allocation will look at the market regime and the market behavior.
Got it. Got it. So the next question is from Nikunj. He's asking, before
Hmm.
6 months, the benchmark of right momentum was equity small and mid cap, but now it is equity large cap. Why has it been changed? Please throw some light on it.
Yes, so we don't change it, right? Like, so it is small case,
Right.
which sort of changes it based on the stock composition, right? So when it sees that a particular basket has high, small, and mid cap allocation, it changes the benchmark to small and mid cap. So when it sees that a particular basket has high large cap exposure, it changes it to large cap. So right now, because in the risky scenarios, large caps tend to do better than small caps, right? So those baskets have a higher allocation to larger stocks. So small cases automatically change it to the benchmark to, I mean,
Right.
the benchmark to large.
Makes sense. So we have this question from Satyajit. He's asking, is a SIP advisable to continue in the right small case, and for how long at this point in time?
See, I think a lot of us have a view that in the next 6 months things are going to get clearer, things are going to get slightly better, right? So if you start buying right now, which might be a bottom, right? We are at how much? At less than 17,000 right now. And the market
Right.
has gone to 2,100, right? 21,000. So we are at a low level, and when the market starts recover, then if you have bought a portion of your portfolio at this low level, we're not saying that go all in right now. You do a SIP, you start accumulating small amounts at these lower levels. So when the market recovers, you will see that uh, you know you're seeing a very good growth rate because you bought it at a lower level. So SIP does make sense, right? Like it is logical that we are at a
Correct.
low level and we expect it to go up. So you know you get the maximum
So
benefit when you buy low and sell high, right?
I think it also helps in averaging, right? So it
Mm.
makes a lot of sense when investors, sort of go the SIP way for a longer time.
Right,
So we have this next
right.
question from Anand. He's asking, how do you qualify within the high beta stocks on their ability to tide over the volatility when systematic risks are at play? In essence, how do you selectively cash out?
So when you talk about high beta stocks, you would have seen that many of our portfolios have reduced exposure to high beta stocks, right? So like we have reduced metals, we reduced IT stocks, we've reduced real estate, and a lot of other stocks have sort of gone off. And like I said, our methodology is systematic, right? So either you're looking at the momentum or some other factor, which will automatically start saying, right? So we don't have to go and tell the portfolio, okay, reduce allocation to IT
Right.
or whatever. Yeah. IT automatically is getting deallocated because of the price pattern or the earning patterns that these stocks are showing.
Correct.
So
Got it.
that is how the
So
select.
there's right. So there's this question from Ankit. He's asking, does Right Research have any plans to bring any FNO strategies in the near future?
So we do have FNO strategies. These strategies we sort of run some large with some large customers, right? Because FNO requires a lot of margin. We have a couple of option strategies, one on the theta decay theme and one on the option momentum theme. These are on Tradetron, and you'll find links to these from our website. And reach out to us if you need help there. We are trying to build some custom products, right? Where we create these. We give you algo solutions on our website itself, but that is a work in progress. Right now, you can go to our Tradetron page and find these couple of strategies that we offer. And we
Right.
are we love working on F&O strategy, so we are exploring a lot of things. So in the future, you will see other good strategies coming out of it.
Yes, of course. There's this question from Rohit. He's asking, please, can you talk a bit about right small caps and how is it different from momentum small case apart from the difference in the stock universe? What else would be the
Yes,
differentiating factor?
just to see the stock universe is one of the big differences, right? That momentum has large and mid caps, small caps has only smaller stocks, right? But but like small caps is also not just looking at momentum, right? Small cap stocks also have this quality metric, they have growth metric, they have you know volatility metric, right? And how we select stocks is based on a number of factors, even in the small cap universe. So it is a version of our multi-factor portfolio, but for smaller stocks, right? That is what the methodology of. So right now, like you see that like in the like 6 months ago, our small cap portfolio was lagging, right? Because it had high momentum exposure and momentum was crashing in small cap. And right now it is outperforming because it doesn't have high momentum exposure. It has exposure to other factors, right, which are doing well. So in a 1 year horizon, we are slightly better than the small cap index, but we have gone through a process of underperformance and outperformance, and then we've reached this. The idea is obviously that we are looking at a number of factors in small caps. Right? So, and our momentum is only momentum.
Right. That's fair. Um, so there's this question from Praveen. He's asking, is there any small case for long term as a core portfolio? And to add on to his question, I would want you to also, share some experiences of yours that how did you become a long term investor?
Right. So our multi-factor portfolios are long-term portfolios, right? Those are the portfolios that we sort of hold that you can buy and forget. Those are the core portfolios, right? Because those are not momentum portfolios. Those are not one particular theme. They are a mix of a number of themes. They're very well diversified. They have asset allocation, right? So they can give, like we said, we expect them to give you much higher return in the market in the long term. So those are the core portfolios that you can have. To answer your second question, Siddharth, obviously I am also, whenever you start in the market, right?
Right.
I actually used to, when I started working in the, looking at the market, I used to work on a brokerage desk, right? And
Correct.
I sort of did F&O trading and, speculation even before I started doing equity investing, right? And
Right.
but in 2013, 14, in times like those when we saw that you could pick a stock and it could suddenly give you that multi-bagger return. Uh, so that really changed my perspective to start looking at other things apart from these short-term intraday F&O gains, and then I started researching on equity valuation and things like that, how to identify good stocks. Uh, then we used to do a lot of momentum investing because momentum was something that was really working well in 2015, 16, 17, right? So we used to focus a lot on momentum investing, and when momentum crashed in 2017, 18, that's when I thought then let's also work on other factors, right? So that is when I started the research on other factors, and now I sort of have this multi-factor approach, and everything
Right.
I sort of try to talk about tends to come with a lot of data driven research. Obviously, all of us are spoiled to that right now, right? We
Right.
go on Twitter and say, we got 100% wrong. Like, we're all spoiled like that. But,
Right.
as long term investors, we should be talking about long term things instead of short term
Perfect.
achievements.
Right. Got it. Thank you for sharing that. So, just to keep everything in the interest of time, we'll take the last few questions and then probably wrap this session up, right? So there's this question from Shade. He's asking if momentum strategy was monthly, earlier and currently it is done weekly, do you think there is requirement for changing stop loss?
Uh, mm, no, so we are looking at 10% odd stop loss, and what I've been thinking is that we will probably switch to monthly soon, right? Because weekly, it causes unnecessary churn in people's portfolio if you're sending out an update every week. So we will probably start reducing the number of updates going forward and slowly switching it to monthly only, because there's not much difference in terms of performance between monthly and weekly, but the churn increases a lot in weekly, right? So that is what has been my I've done some sort of analysis, and that's what I've sort of understood. uh,
Got
that is
it.
what I sort of think.
He has
Yeah.
he has another question. He was asking, can we get mails for rebalance a day before the rebalance happens?
Yeah, so this time we had put it on all our social media channels, right? That these are the changes that are
Correct.
coming. So you can follow our Telegram, right? We are at Wright
Yes, on
Research on
Telegram
Telegram,
we,
and yeah,
yes.
on Twitter we are at Research Right. Uh, on LinkedIn, Instagram, everywhere we do post very actively on all these key things. We do post. Follow our Telegram channels, or uh, you will receive those updates. Mailers, we typically, we send out these mailers to everyone, to not, so it is slightly difficult for us to differentiate who is the subscribed user and who is not a subscribed user. So we don't just put out the whole update to everyone. Uh, but yeah, we do notify that what are the number of changes coming a day in advance, and that is what we'll continue to do. And uh, on the revalid update that you get there, we are now adding a very detailed explanation along with a blog post and a video, or how the rebalance is coming. So I hope that would help. But yeah, for more active, and we don't want to spam you, right, by sending you too many emails. So we don't send you too many emails.
Right.
We try to keep it once a week or lower. So but do follow us on the social media, Telegram, Twitter, LinkedIn, etc., to get these active updates.
Yep, yep. I think we're very active on all the social handles and we keep pushing updates regularly. So once you guys follow us there, you'll be updated with whatever is happening, right? So just a quick question, Sonam, and probably then we can wrap this up to keep everything in the interest of time. So after this sort of volatility that we are facing, the markets are facing, the investors are facing, how should investors focus? What should they focus on? Some parting away tips if you could share.
Yes. So in these volatile times, you should focus on the sector allocation that you're doing, right? You should see that you should be shifting a little bit more defensive right now. Your asset allocation should be correct, and always look at it from the long term perspective, right? So you do these risk management things, and I sort of I am one of those managers who started in 2019, right? I think a lot of managers that you're seeing, they started in 2020, 21 when the markets were going up like anything. Like we started in 2019 when there was no need for us to start. The markets were not going crazy, right?
Yeah.
And the motivation for us to actually do this is to sort of give you an outcome in our market share. We see there are opportunities that work even in volatile times, and we want to identify and present it to you. Uh, so yeah, so you should get your sector allocation right. Focus on what factors are working. Keep a monitor on the macroeconomic situation that will help you guide your allocation. Be patient, right? That
Yes.
is what.
Yes.
Okay. Yeah.
Perfect. So I think we've almost answered all the questions. In case, guys, you have any further questions, feel free to drop it on the community page, and we'll take it up from there.
Yeah, and thanks a lot everyone for joining us today, and thanks so much for filling us the survey that we have posted. We'll give you the discount code by tonight, right? And thanks a lot for everyone. We really appreciate you guys joining us and giving us this response.
Right. All right. Thank you, everybody.
Thanks,